We believe that real assets can be a valuable part of diversified portfolios. At Mercer, our KiwiSaver and institutional funds, using a multi-manager approach, invest in a diversified selection of local and global real assets, both listed and unlisted. Globally, Mercer manages around about $350 billion, and over 10% of that is invested in alternatives and private markets, including real assets. So it's an area that we've been allocating more to and allocating more research and portfolio management resource over recent years. So today I'm going to start by describing what we mean by the term real assets and what are the defining characteristics. I'll then describe from the perspective of an asset allocator. And by the way, I really like Martin's comments on asset allocators earlier this morning. What it is we're looking to achieve by investing in this sector. What are the outcomes we're seeking for our investors? And then I'll briefly look at a high level at how investors can access real assets. I'll then hand over to Paddy and ask him to describe, from the perspective of a real assets portfolio manager, how he would go about achieving the outcomes that we're seeking. And he'll also provide some case studies from his role as head of real estate for the Pacific region, although he is based here in Auckland. And then I'll wrap up by looking at an example of the allocations in a balanced fund context. So what are the defining characteristics of real assets? First of all, despite what the real asset specialists might try and tell you, the term real assets doesn't imply that all other assets are somehow not real or artificial. We would characterise them as assets which are typically physical in nature or tangible, sort of the opposite to the cryptos. So namely real estate, infrastructure and natural resources. We think they have some unifying characteristics. Firstly, a defensible earning stream which generates a return for investors. That's so starting on the left there and sort of working anti-clockwise. Secondly, that they provide a storage of value through a set of difficult to replicate underlying physical assets, which in some cases provide essential services to the community. Thirdly, that they tend to have a significant income component that is often linked directly or indirectly to inflation. So just by way of example, some assets in this area can contractually increase revenues with inflation. And then historically, when you look back at real asset returns, they historically have had a higher positive correlation with inflation, compared with shares and bonds. And we'll both show a chart on that shortly. And then also that they have outperformed historically in higher inflation environments. And fourthly, up the top here, that they should serve as a diversifier within a multi-sector portfolio as a result of their different return and risk drivers. This is partly because they can provide exposure to what we call non-corporate GDP growth. So in other words, growth in the population and growth in the economy, which is not so closely tied to the profit growth of public listed companies. So I'm just going to spend a bit of time on this point about diversification because it is important and it's helpful to talk about some examples. So there are a wide range of entities which use real assets and are therefore sources of cash flows for those real assets, with the key example being that these entities rent buildings, and I'm talking about entities that aren't listed companies. So it could be private companies, partnerships, co-ops, public sector organisations, healthcare or educational entities. And of course in New Zealand in particular, these entities significantly outweigh the listed corporates, certainly in number and also in size. Secondly, that there's growth associated with population, and of course also in New Zealand, temporary visitors, tourists, which results in increased traffic on toll roads, people using electricity, gas and water, people travelling through airports, the growth in data, which needs cell towers and data centres, and all of those things which can potentially be targeted through infrastructure investments, which aren't, again, necessarily tied to public companies' profits. And then finally, there's organic growth. So as far as I'm aware, trees keep growing whether shares are in a bear market or a bull market. So those things all represent different underlying sources of cash flow which are harder to access for investors invested in portfolios dominated by shares and bonds. Of course, we can't say that there's no correlation, because there is. Real assets will, to varying degrees, exhibit a positive correlation with equities, due to common return drivers such as discount rates and changes in economic growth and inflation expectations. The final point I want to make on this diversification point is around the valuation lag. Generally speaking, unlisted assets will have a valuation lag because of the appraisal-based approach to valuation. As a result, they won't tend to be valued up as much in the upcycle, and also tend not to fall as much in the down cycle. Of course, it's important to be aware, though, that the actual risk of the unlisted assets is higher than just sort of taking a simple standard deviation of those returns would suggest. So we try and take account of that in our modelling, so that the lag is not really a material factor in when we're setting our asset allocation and looking at the benefits of diversification. Listed real assets, so listed property, listed infrastructure, of course, will be the most correlated with shares, but they tend to have a beta below 1. And the correlation between listed real assets and shares tends to fall the longer the time frame you're looking at, while at the same time becoming more correlated with the underlying physical assets. So just touching on a couple of the points I made earlier around those characteristics and providing some evidence. So this chart demonstrates the inflation sensitivity over a couple of time frames, 1973 through to 1996, and then 97 through to 2017, and then the full period. So on the right-hand side, you'll see the real asset sectors, infrastructure, commodities, natural resources, and REITs. While on the left, you'll see shares and bonds, and you can see that, broadly speaking, that the correlation tends to be higher on the right-hand side, which supports my earlier claim regarding the inflation sensitivity of those assets. I also mentioned the characteristic of a defensible earnings stream, which helps generate a return for investors. Now, this chart shows for global listed property the annual income yield, which is in a blue bar, and then capital growth, which is the orange, and then a total return, combining the two as the line. I mentioned earlier that the correlation with equities can vary over time, and you can see that during the global financial crisis, that dip in the middle, that global REITs became highly correlated with shares, which was mainly due to the leverage, and Paddy will touch on that shortly. But while it's worth noting that while the capital losses were material, the income yield, which remained relatively steady, helped mitigate those capital losses. So what do we want to achieve from our real asset portfolio when setting our strategic asset allocation? So the top priority for us is to get exposure to those 4 defining characteristics, which I've just outlined, plus a couple more objectives on top. So just to quickly recap, we're seeking income with growth in that income and an element of positive sensitivity to inflation and storage of value. And we want to increase our portfolio's diversification away from equities and bonds. So the 2 additional objectives of creating value and a positive ESG impact. So on the value front, we'd like some value to be created in a way which is different to other forms of alpha in our portfolios. For example, the stock picking in the listed equities. In particular, what we're talking about is the illiquidity and complexity premiums that are typically available in private markets. So we want the ability to shape the return stream by having some control of the underlying asset, or the sectors and the assets. For example, by pursuing certain themes and tailwinds, or just simply refurbishing an asset. And Paddy will provide some more examples of that value creation. In terms of ESG, the ESG aspects of any investment are important to us, and increasingly so for most investors, as Cecilia mentioned this morning. real assets by definition have a heavy responsibility in this regard in terms of both their effect on the environment and their effect on society. So in these sectors, you can't ignore ESG considerations, and any fund manager doing so is at risk of destroying value for their clients. And the opposite is also true. Managers with a strong ESG focus have the potential to add material value to the assets that they own, and that's why we give all the managers that we research and invest with a separate ESG rating, reflecting how much they're integrating ESG into their process. So, assuming that we can achieve those objectives, another important step in building a real asset portfolio and deciding on the right allocation to it in a diversified fund is about striking the appropriate balance between a few other things: complexity, tolerance for complexity, what's the scale that we're allocating, what's the cost, and what's the need for liquidity. So this also needs to be part of the asset allocation process. Paddy, I'm now going to hand over to you now to talk about building a real asset portfolio which incorporates those objectives that I've just been referring to.
Great. Good afternoon, everybody. As Philip mentioned, I'm the portfolio manager for Mercer's real asset portfolios, part of a group which manages over $40 billion New Zealand dollars globally, and about $4 billion of that FUM is invested into Australian and New Zealand real assets. So about 250 real estate assets in Australia and New Zealand, and about 70 infrastructure assets. So it's an asset class that we like. We've resourced up pretty heavily to invest our global funds, including Philip's New Zealand clients and KiwiSaver, into these real asset products. But over the next few minutes, I'm just going to guide you through some of the steps that we've taken in Mercer to build our real asset portfolios. And then bear with me, because I'm going to take you through some case studies, so some examples of how we've actually implemented that theory over the course of the last few years into building portfolios. So, as Philip's pointed out, real asset returns are dominated by the income yield of the asset. The capital value's underpinned by the intrinsic value of the underlying assets. So, example of real assets here, we've got infrastructure, property, so not residential property generally. So if it's residential property, it's multi-family, so many dwellings together. But we're talking about commercial, industrial sheds, logistics warehouses, large-scale shopping centres, generally assets valued above $50 million, so institutional grade, of which there's only a handful really in New Zealand. So a lot of our portfolios have been invested into Australia to date, but we're very much in the market for local opportunities. I think just if you're thinking about real assets, how to define them, and Philip's given you some starting points there, but they really are predictable cash flows. They're tangible assets that you use every day. So you can really think about them as a high quality cash flow with an irreplaceable property attached. So you're kind of getting the best of bonds and equities in my view with these asset classes. Given the time constraints, I'm going to speak mainly about real estate today, but my comments are going to be applicable to all other real assets also. So why do we invest into real assets? And I just missed a chart there. There's some nice pictures about real assets that we invest into. But the main reason, as Philip pointed out, is to get diversification from other asset classes in the portfolio, but also for the strong return characteristics of real assets. So you can see there on this chart returns for real estate as a proxy for real assets versus other asset classes over a number of different time periods. And we're a bit fortunate to be in a period where real estate returns, and these are unlevered real estate returns, have been pretty much higher than every other asset class if you're looking at Australian data. Levered real estate is going to be significantly higher in terms of returns, and I think my next speaker is going to provide you with some examples of levered real estate or more private equity type real estate returns. But this is core low risk real estate dominated by income in these returns. And I'll point out there the difference between the real estate returns on the left-hand side and the REIT returns, the listed real estate returns on the second chart from the left. And you'll see there's significantly more volatility in that listed real estate chart, so a lot more like equity-type returns over the short term. Over the medium term, they're starting to converge more. But you've got at the tail end there, you've got a very strong underperformance from listed, and that's the GFC impact. So a lot of listed real estate trusts got themselves into trouble in the GFC. They had far too much debt. When the valuations did decline, the bankers started calling in some of that debt. They had to do dilutive equity raises. So I think just it's a warning when you're investing into real assets. Unlisted is probably the preferable way to go, albeit you will see some attractive opportunities through the cycle at listed valuations. On that series of data, unlisted real estate's outperformed equities and global bonds by quite some margin. I think through the cycle, you'd expect it to be somewhere in between the two. So you really are in a sweet spot for real estate and real asset returns at the moment. But long term, it should really be a mid-risk asset class between equities and bonds. And compared to inflation, you've got significant outperformance over all time periods there. So back to Philip's point about inflation protection previously. But I think what we're really trying to show there is that while the correlation to inflation might not be perfect or perfectly negative for real assets, if you're investing in these assets class through the long term, which is how you really should set up your portfolio, given the high transaction costs, high due diligence costs to invest into, then you will actually outperform inflation quite significantly. And this data here is from the UK. It's over a long period of time, and so you're looking from since the Second World War until today, real assets have significantly outperformed inflation, so through that long-term time period. But what I would pull out from this is that the breakdown of that outperformance is quite interesting. So you've got three different periods of significant inflation, or of inflation there, and how real assets have responded. And then if you look at the breakdown of that real asset return, so the blue bar being, or the dark blue bar being the income return, sorry, the capital return, and the grey bar being the income return, which sums together to the yellow bar. In the early periods, so in the periods from 1947 to 67, and again from 1981 to 2009, we had what was called demand pull inflation, and the income component contributed strongly to real estate return in that period. However, if you're looking at the cost push inflation of the 1970s, when oil prices rose by over 500%, the capital value component, or the capital growth component of real assets, is what really bailed you out in that period. So real assets can respond to inflation in different ways, and I think it's a really neat characteristic of the asset class when you're setting up your portfolio. And maybe ACC could get a higher allocation to real assets to meet that long duration and inflation sensitivity requirement. But remember that real asset values are really underpinned by the cost to replace them. So these are hard assets built largely by commodities, by labour, and so on. So the cost of commodities, labour, and the land use in the construction are all components which generally provide good inflation protection, and that underpins the valuations of real assets. So let's get into building a portfolio, and you can obviously invest into real assets via different parts of the capital stack, through listed, unlisted, through the equity component, through the debt component. All have got merits at different points of the cycle. So we think the listed markets are fantastic for real assets, but probably unlisted markets will give you more of those characteristics that Philip highlighted that you'd be looking for. So listed markets really do provide you with significant opportunities to invest across all the real asset categories: real estate, infrastructure, natural resources. And you can build your portfolio globally and quickly by going into these listed markets. There's very good exposures to these asset classes globally. But just be aware that, as you've seen, investments can exhibit similar risk and return characteristics to equity markets over the short and medium term. So just be aware of that volatility. When you're investing through unlisted exposures, it's going to take you a lot longer to build your portfolio, and you have to put a lot more resource into building that exposure. It's good, but it does give you the potential to get greater control over your portfolio. You do get the potential for an illiquidity premium, and you get access to assets which are not available in the listed markets. So for investors with the luxury of a long time horizon, unlisted core exposures can provide you with strong returns, as we've seen throughout the investment cycle. The opportunity set in unlisted real estate and real assets is actually increasing. So similar to the private equity conversations earlier on today, we're seeing a lot of take privates in this space here. So large global pension plans have been privatising REITs, as have private equity fund managers for quite some time, and the same in the unlisted listed infrastructure and natural resources space. Real estate debt and real asset debt is interesting, and particularly as we approach late stage of the cycle. Through the cycle, returns will be lower in debt, but it's an interesting point, an interesting opportunity to invest, particularly during late cycle dynamics and periods of dislocation. You can see outsized returns for the risk you're taking by investing through the debt stack. Risk of investing across the asset classes, your tolerance for risk is something you really need to understand. So in general, lower risk real assets, such as core real estate and infrastructure, will have returns dominated by income, whereas the higher up you go that curve up towards value-add and opportunistic returns, your return will be largely dominated by higher leverage and capital growth. So where you do get those outsized returns, so we're looking at 14, 15% plus target returns, a lot more of that's going to be at risk in a market downturn, or if you do lose control over the assets through having excess debt in the stack or losing tenants and so on. So you need to set up your portfolio with your risk tolerance in mind, and be very careful of where you are investing on the stack. So core real assets, which include well-located assets featuring long leases to high-quality tenants, are the kind of assets which dominate most investors' real asset portfolios. But there is opportunity, obviously, for taking satellite approaches to higher risk strategies. The further up the spectrum you go, the higher fees you're going to be paying also. So again, fee budgets for investors are going to come into consideration here. Diversification is a really key point with investing in these asset classes. So this spread here looks at infrastructure funds. So from different vintages, so funds that are raised in different vintages, and what the mark-to-market or realised IRRs of those funds are on the left-hand side, and then the multiple on the right-hand side. And you can see there that a huge spread between the highest performing funds and the lowest performing funds. So it's about 30% in many cases, if you pick a winner or you pick a loser. So diversifying your portfolio is absolutely key with real assets, as it is with other investments in your portfolio. While the median return is attractive, it's hard to get that median without diversifying your portfolio. So just be very careful how you set up your real asset portfolio going forward. And you're invested in real assets for the long term, so do a lot of DD up front before you make that investment decision. Investing for the long term gives you the luxury of backing long-term supportive tailwinds, mega trends, thematics in the market. So particularly investing through unlisted investments, you've got the luxury of not being distracted by daily market volatility, and you can back some of these long-term thematics, which do provide you with a lot more security in your return profile. So you're not really at the mercy of what the market is doing. There are thematics at play which you can back those tailwinds. So it allows you to reduce the risk by targeting some of these long-term megatrends and thematics. For example, demographic change, technology and sustainability. And we've heard a lot about those through our private equity conversations earlier today. One other theme I'd pull out that we're very much focused on is increasing longevity and the significantly increased demand for housing and medical care. Quick stat here, over the next 30 years, the number of Australians and New Zealanders aged over 85 will increase threefold, which is providing a critical need to invest in improved housing and medical facilities for over 1 million additional elderly people. This will occur regardless of the economic cycle. Positioning your portfolio is very important. So how do you access these real assets? I think you need to ask internal conversations here when you're building the portfolio. So how capable and well-resourced is your internal investment team? What's your ability to pay fees to external investment managers? What are the tax implications of investing internationally? So it really depends on how you actually approach this asset class. And we heard earlier from some of the large funds who are investing directly, but they're going to be the minority. I think unless you've actually got a large investment team you can resource up well. Most of the smaller institutions are going to go through a fund-to-fund, manager-of-manager type approach. They might invest into wholesale funds, but direct funds do require significant resources internally. Philip touched on ESG and responsible investing, as did a lot of the panellists earlier on today. It's a really key point for Mercer, so we've got a very big responsible investing practice. They've really emphasised that the time to position portfolios for climate change has very much arrived, and our portfolios are adjusted accordingly. So we see sustainable infrastructure in particular as providing outsized returns should we have a global warming scenario. But more to the point, we're actually positioning portfolios now for resilience. So how does existing portfolios perform in the event of global warming, rising sea levels, and so on? And governance is an absolute key point with real assets. You own these assets for the long term. You need to have seats on advisory committees, on management boards, and so on. Really understand how these assets are being managed and be able to intervene where necessary. So thanks for bearing with me through the theory of building a real asset portfolio. I'm just going to talk to you quickly now through some of the case studies that we've actually built recently. So this large 70,000 square metre logistics asset, which is built over 17 hectares in southern Melbourne, it's Woolworth's brand new distribution centre. It services over 200 supermarkets in the Australian state of Victoria. And it's designed to be operational 24 hours a day, 7 days a week. The facility combines leading logistics and manufacturing technologies, including multi-storey racking systems, robotics and high-speed conveyor and sorting systems. These sort and distribute stock faster and in the right sequence with much greater accuracy than traditional warehouse technology and meet the specific needs of those stores. So the building features the largest solar panel installation in Australia. It's over 4,000 solar panels, which deliver enough power to produce for 250 houses. Woolworths on this asset have signed a 25-year lease, so on this critical operating infrastructure, with rents are growing by around 3% annually contractually. So it's above the long-term rate of inflation. And for our portfolios, this investment provides the funds with exceptionally long-term and a growing cash flow, backed by a high credit quality tenant, and the asset is located in one of the region's fastest growing cities, underpinning that land value. We also operate across the capital stack. So this investment here, we see abilities to drive significant value by operating across a number of different capital markets. Real asset investors are well placed to take advantage of investments which may be mispriced by inefficient markets, as assets trade irregularly and information is often non-public. By operating across real asset capital markets, we can assess how direct markets, indirect markets, and listed markets are valuing a similar asset. It's noteworthy that there are some significant differences in valuation methodologies and transaction costs in these different markets, which make comparing like-for-like difficult to the casual market observer. For example, this dislocation is illustrated here in the Sydney office markets. We were recently involved in the sale of a well-located but low-grade office asset at 48% above its book value. That's the asset on the left hand here, about $21,000 per square metre of lettable area. The offshore buyer paid a 6% transaction cost to buy that asset, which is in addition to that premium to book value. We then reinvested the proceeds of the sale into an unlisted fund, which owns a gateway tower overlooking Circular Quay, a significantly better asset, one of Australia's premier office assets, and the valuation on that asset was $22,000 per metre, so pretty much the same valuation to trade up into the best asset by playing the capital markets. But we acquired these units at a 1.5% discount and paid no transaction costs for that exposure. So I think there's really good value add potential by playing across the capital structures with real assets. Similarly, we've been backing into thematics, into tailwinds. We've invested heavily into data centres in the US, into renewable energy in Europe, really focused on those long-term sustainable trends or the long-term thematic of increasing data usage. With these assets, we've been buying assets which are located in critical infrastructure nodes, so very difficult to replicate. And we would like an asset a lot. We'll buy it directly or through a co-investment type structure. So this, for example, is 420 George Street in Sydney, which ticks all of our boxes when we're given an off-market opportunity to acquire it a few years ago. The building's exceptionally well located above Pitt Street Mall, next to the Strand Arcade, and it has leading industry sustainability credentials. So at the time of acquisition, Sydney was on the verge of a major building and infrastructure boom, which saw 8% of the existing office stock demolished, pushing vacancy levels below 4%, and a corresponding spike in rents. So over the past few years, Sydney has experienced the highest rental growth globally. And I think this provides that via a direct acquisition, we were able to take views on a market direction and take a micro bets on a market, which would be much harder to do through a fund or through a listed vehicle. So I've run almost over time, but thanks very much for bearing with me. And this is how we've put together some of the theory behind building real asset portfolios.
We're not quite done yet. So I'm going to just very quickly wrap up now by looking at how much to allocate to real assets in a diversified fund. So as part of our process, we try to quantify the benefits of that diversification that I was talking about before. So looking at, trying to quantify the effect of that diversification on the drivers of return and risk, and we've built a factor model to try and help us do that with all the qualifications, of course, that go with any model. But this chart shows the return contributions as a percentage of total expected return from a range of factors. So on the left, the column on the left you'll see is a balanced fund with no real assets, while the one on the right includes an allocation to real assets. And you'll see that the one on the left, so that blue, the large blue area, is the contribution from the equity risk premium. So you can see the one on the right, it's still dominated by equities, and the same as would be true if you're looking at risk contributions. But it does have some extra contributions or contributing factors, and these include that non-corporate GDP growth I was talking about before, the alpha, the illiquidity premium, and a couple of other small ones as well. So that was consistent with what we're wanting to achieve. Of course, each one of those is, they're pretty small slices, but they all add up, such that the equity risk premium, which is the largest contributor, has dropped from 88% for the one with no real assets down to 75% to the one with real assets. So in this balanced fund, so this is the one for which we did the modelling on, which is representative of our Mercer KiwiSaver and our institutional balanced fund, so which are obviously constrained by both liquidity and cost. The allocation to real assets is just over 13%, approximately half of which is unlisted and half of which is listed. And you see the subcategories here, so again, some small slices: property and infrastructure, listed and unlisted, and natural resources, which we haven't talked about much so far, but that includes a mixture of, again, unlisted timberland and commodity futures. Within those slices, there's 15 underlying investment managers, there are 150 listed securities, and more than 300 underlying private assets. So in conclusion, we believe it is possible to build a real assets portfolio which achieves those objectives that we set out to achieve. We also believe that real assets on average remain underrepresented in investor portfolios, and exposure typically may only be through one or two sectors. And yet it's unlikely that an allocation to a single real asset sector or fund can really deliver the broad range of benefits that we think real assets can provide. In our global unconstrained sort of reference portfolio, we have a similar allocation to real assets, but it's all unlisted assets. We've seen endowments both here in New Zealand and globally adopt higher allocations than the allocation I showed you before, and that's because their need for liquidity is less. And you look across at the industry schemes, super schemes in Australia, and some of them have got over 30% in real assets, and that looks to be heading even higher as well. It's quite a contrast, isn't it, when you look at the Australian super funds with those kind of allocations and New Zealand KiwiSaver funds, which generally have, sometimes none or very little. But both ostensibly are trying to achieve the same goals, but going about it in very different ways. So as the market evolves, we think that opportunities will increase across the full spectrum of real assets, allowing more funds to consider making an allocation. Happy to take questions. Thank you.
Good. Congratulations.